Carrie and Dalton wrote in with a question: how does the federal government set interest rates for home loans? It's interesting that Carrie assumes that the federal government does set interest rate for home loans. And in many cases, some of the advertising that goes around interest rates increasing or decreasing basically ties interest rates on home loans, home mortgages. In the state of Georgia, we don't actually use mortgages. We use what are called security deeds. So if you ever hear anybody talking about a mortgage in Georgia, we don't really have mortgages. We have home loans with security deeds. And people say, lenders say, loan originators say, Federal Reserve has decreased the federal funds rate, therefore interest rates on mortgages will go down. That may or may not be true. So what happens is the mortgage market interest rates are really set by the yield on the 10-year treasury bill or treasury bond. And I know you're thinking, well, how does that work? Well, the U.S. Treasury bond, people from all over the world, people in the United States and countries and investors all over the world buy U.S. debt, by treasury bills and treasury bonds that are sold by the U.S. government. It allows us to borrow money as a country, do it at a very low interest rate. I know it's a very sensitive thing now that our debt is up to 16, 18 trillion. I don't remember what it is. It's a huge number. It's out of control. But what happens is investors who consider investing in treasury bonds and treasury bills in the United States consider a mortgage-backed security or a security sold by Fannie Mae or Freddie Mac, which are both government-controlled entities here in the United States. They consider mortgage-backed securities sort of the second safest investment. And the reason the mortgage-backed securities and the treasury bills and treasury bonds are considered a very safe investment is because they are backed by the full creditworthiness and faith of the United States government. Now, I know that seems like an oxymoron that I'm saying. They are backed by the full credit and faith of the U.S. government. But the reality is, compared to other governments around the world, an investment in the U.S. government or a debt owed by the U.S. government is considered to be the safest place to put your money in the world. So as the yield on a 10-year treasury bond or treasury bill goes up or down, so follows the mortgage interest rate. And the reality is that interest rates tend to have an inverse relationship with stability and security around the world. So as the world becomes more stable, let's say, for example, after this crazy pandemic that we've been through, as the world becomes more stable, it is likely that interest rates will go up, because it is instability throughout the world that encourages investors, countries, and individual investors alike to invest in U.S.-backed securities. So when you have uncertainty in the world, interest rates tend to be low. When you have certainty and a feeling of security in the world, interest rates tend to rise. So if you wanted to know whether or not I thought interest rates would rise over the next 12 months, I'm not a betting man, but if I were a betting man, I'd be willing to bet a substantial amount that interest rates are going to rise. And what's interesting is if you look at a 30-year fixed rate on a mortgage at, let's just call it 2.75%, and it goes to 3.75%, I'm just rounding, but you'll ultimately pay 25 or 28% more in interest over the life of the loan. So if your interest payment was $1,000 at 2.75%, your interest would be $1,280 or $1,250 a month at a 1% higher interest rate. So it does make a huge, huge difference.